Welcome to Section 7 of 11 in the Inventory and Cost Accounting Cycle. This is Phase F, where everything you have built so far finally pays off. We take goods out the door, recognize their cost, and report on how the whole cycle performed. By the end, you will see how cost accounting becomes business performance reporting. Let us get started. Here is what you will be able to do by the end of this section. First, explain how cost of goods sold, or COGS, is recognized under both perpetual and periodic systems. Second, apply first-in first-out rotation, the FIFO method, when goods are fulfilled. Third, analyze gross margin and understand what moves it. Fourth, identify the procedures external auditors perform and the disclosures required at year-end. And finally, record the annual updates to standards and the ABC model. Each of these closes the loop on the cycle. Everything starts when a sales order is approved back in Cycle 1. The warehouse then picks, packs, and ships the goods. Here is the key thing. The picking slip records the actual lot numbers shipped, and FIFO rotation is enforced physically on the warehouse floor, so the oldest stock leaves first. Why does that matter? Because the cost you recognize must match the goods that actually moved. Inventory is relieved at the point of confirmed shipment if you run a perpetual system, or at period end if you run periodic. That timing decision shapes everything that follows. Now the accounting. The golden rule is the matching principle. Cost of goods sold is recognized in the same period as the related revenue. You cannot book the sale this month and the cost next month. Under a perpetual system, every single sale triggers an entry, debit COGS and credit finished goods inventory, at the cost determined by your costing method. The surprising part for many people is that the system does this continuously, in real time, with every shipment. So the moment those goods leave, both your revenue and your cost land together. But periodic systems handle this differently, and that is where we go next. Under a periodic system, you do not touch COGS at each sale. Instead, you wait until period end and calculate it. Beginning inventory plus purchases minus ending inventory equals cost of goods sold. For a manufacturer, the middle term changes. You take beginning finished goods plus cost of goods manufactured, the COGM, minus ending finished goods. In practice, this means your COGS is only as accurate as your physical count of ending inventory. Get the count wrong and the cost is wrong too. That dependence on counting is exactly why the costing method you choose matters so much, which we will see now. Here is where method choice shows its teeth, especially when prices are rising. Under FIFO in an inflationary period, you use the older, cheaper costs first, so COGS comes out lower and your ending inventory comes out higher. Weighted average produces a smooth COGS that sits between the extremes. Standard cost records COGS at standard, with variances tracked separately and closed at period end. Most people assume the method is just a bookkeeping choice, but it directly changes your reported profit and your balance sheet. That is why understanding the gross margin it produces is the real payoff. Gross margin is where cost accounting becomes business storytelling. The math is simple. Revenue minus COGS equals gross profit, and gross profit divided by revenue gives you gross margin percent. But the power is in slicing it by product line, by customer, and by channel. Here is the key thing to remember. Gross margin analysis is the primary bridge between cost accounting and business performance reporting. It is how the numbers you have been building all cycle finally tell management whether the business is healthy. And when a margin moves unexpectedly, you have to find out why. When gross margin shifts significantly versus the prior period or the budget, you do not shrug, you investigate. There are 4 usual suspects. First, purchase price changes, your inputs got more or less expensive. Second, a mix shift, you sold more low-margin products and fewer high-margin ones. Third, write-downs embedded in COGS, losses that quietly inflated cost. And fourth, overhead absorption changes, the way fixed costs landed on units moved. Without this investigation, a falling margin looks like bad luck when it is actually a fixable problem. Tracing the cause is what turns a report into a decision. Management does not wait for the annual audit to know how things are going. They review inventory performance KPIs monthly. Inventory turnover is COGS over average inventory, how many times you sell through your stock. Days inventory outstanding is 365 divided by turnover, the average days goods sit before sale. Then gross margin percent by product line, the variance percentages, and the overhead absorption rate, which connects daily production to financial statement accuracy. Watch shrinkage, slow-moving inventory over 90 days and obsolete inventory too. These metrics are your early warning system, long before the auditors arrive. Version 2 of the handbook adds cost accounting KPIs on top of the operational ones. Inventory accuracy rate measures the percent of SKUs where the physical count matches the system balance within tolerance, checked every count cycle. Work in process cycle time, the WIP cycle time, tracks the average days from raw material issuance to finished goods transfer. Landed cost as a percent of purchase price tells you how much freight and duty inflate your invoice cost. And the standard versus actual cost gap flags drift between what you planned and what you spent. In practice, these numbers tell you where to look before a small gap becomes a big surprise. Once a year, external auditors step in. They attend the physical count, or a representative portion of it, and perform their own independent test counts to confirm what you reported. They evaluate your lower of cost or net realizable value, the LCNRV, and your obsolescence reserve assessments. They test the costing methodology, the equivalent units, the overhead absorption rate, and standard cost accuracy. And they assess how you disposed of your variances. Without this independent check, no outside party could trust your inventory number. The audit is what gives your financial statements credibility, which leads directly to disclosure. Now you tell the world. Under a SC 330 and IAS 2, the inventory note must disclose several things. First, the costing method applied, whether FIFO, weighted average, or standard cost. Second, the carrying amount by category, raw materials, work in process, and finished goods. Third, any write-downs recognized. And here is a key difference. Reversals of prior write-downs are disclosed under IFRS only, not under US GAAP. For manufacturers, the cost of goods manufactured statement is often presented separately in the management discussion or the notes. Getting this disclosure right is the final, visible product of the entire cycle. Before a new production year begins, you refresh your foundations. All standard costs are reviewed, and you document both the update process and its profit and loss impact for management. You also reassess your activity-based costing model, the ABC system, asking whether the cost pools and cost drivers still make sense, and whether product costs still give accurate profitability signals. Here is the trap most people miss. If production methods, automation, or product mix have shifted, an old ABC model quietly misleads you. Reviewing it keeps your costs honest for the year ahead. Let us bring it together. COGS is recognized in the same period as revenue, whether you book it per sale under perpetual or by formula under periodic. Your costing method directly changes both COGS and ending inventory, especially during inflation. Gross margin analysis is the bridge between cost accounting and business performance, so investigate every significant change. External auditors test your counts, reserves, and methods, and you disclose under a SC 330 and IAS 2. And each year you refresh your standards and your ABC model. Next we move into Section 8, the full set of 16 journal entries behind this cycle. Thank you for completing this section on sales, COGS, and reporting.